Hi, Ira Coiner here, President and founder of Triathlon Partners. Thank you very much for tuning in to this episode of Triathlon TV, where we will be discussing a specific structured note that will be issued at the end of the month. Now, we like structured notes at Triathlon Partners because they offer an enhanced return greater than 1-to-1 as on the positive markets, and they also offer some protection against markets that go lower, right? So when we can minimize the number of years that are negative and get a nice kicker or boost and overperform the market when it's positive, that's really a very good investment in our eyes. And these structured notes for the long-term investor are fantastic because to take advantage of that and of those properties, you need to hold your investment for the length of the note duration, which in this case is 5 years. So if you have a 401k from a former employer, this is a great place to put it because number one, if you need cash to put it into this note, selling out appreciated stock in a 401k isn't a taxable event. And all of a sudden you have something that's going to give you some downside protection as well as increased gains on the top side, right? If you have extra cash sitting in a regular taxable account, this is a good investment as well. Now, the note that we're talking about today covers an international exposure, international equity exposure. We're either talking about it's going to cover one of two indexes. We don't know which one it's going to pay out on. And the reason is that when we do this in a note, you're able to get very good terms. So one of the indexes is going to be on the top 50 stocks in Europe, the Euro 50, the Euro Stock 50. The other one is a very popular ETF, which covers non-North American large cap stocks. So large cap companies in Europe, in the Far East, and Australia, right? So this note, again, is for 5 years, and its payout will be dependent upon the performance of the worst of those two indexes. Now, all right. The reason this note is structured this way is that if the worst of these two indexes is positive at the end of 5 years, your return is 2.22 times the return of that index, right? So you're not getting 1-to-1. So don't think of it, oh, I'm buying the worst performing index, but you're getting over 2 times the return of that index. And you get the worst one, and that worst one gets such a big kicker because it is the worst one, right? But there's a lot of overlap in what these indexes cover. And it's all international exposure, which people really need and want in their portfolio. It diversifies it quite well. Now, so for instance, at the end of 5 years, if the worst of these two indexes is up 30%, we multiply 30% by 2.22, which is 66.6%. So it's just straight multiplication, and that's the payout that you get. Now, the performance of these indexes, they do not include dividends, right? That is very important to keep in mind. It's just on the pure movement of each index. Now, what happens on the downside? Now, if the worst of these two indexes or ETFs is negative, well, if it's negative, if it's worth 65% of its original value, so say it goes down less than 35%, so 65% or greater than its value, you get 100% of your principal back. So if the worst index is down 20% at the end of 5 years, you get 100% of your money back. If it's down 30% after 5 years, you get 100% of your money back. Now, what happens if the worst index is worth less than 65% of its original value? Let's say it's worth 60% of its original value, right? That's 40% decline. Well, fortunately, the protection that we had no longer exists, and you will be given 60% of the original investment amount. Now, that's basically the same except it doesn't pay dividends, as if you were long the index anyway, right? And yes, you get the worst one, but let's keep in mind there's a lot of overlap between these two indexes, so they should perform. There should be a very high correlation between the two. Now, again, if you were long these underlying indexes on its own and the market was down 50%, you would have a 50% loss. That's the same as the structured note. If the market was down 25%, the structured note is a much better holding because you get your full principal back. And if the structured note is positive, you get 2.22 times the worst performing index on that. So any way you slice it, this really does look like a nice piece to put into your portfolio because it mitigates losses on the downside and it gives you enhanced returns on the top side. And it actually plugs a nice hole in terms of diversification, having international stocks. So thank you very much for tuning in. Any questions, please contact us. Check out our website, www.triathlonpartners.com. Please, if you like the video, give us, we like our stuff. We like subscribers. We like thumbs up. We like friends and followers, right? So please click those buttons. And again, we view our goal is to engage, educate, and empower our clients to make confident decisions that best fit their objectives. Everyone have a lovely, lovely evening. Have a blessed day, and please stay tuned for the disclaimers. Yes, I know that's everyone's favorite part. So let me share that with you.